So in terms of mortgages, people will go to a bank. They're looking at purchasing a home. They'd like to borrow money from the bank. The question is, where does that money come from, actually? Some of the money at the bank would come from deposits. So we would have checking, savings accounts, other types of products such as GICs. But the banks themselves also borrow money in the bond market. So they go to the bond market, they would borrow money for, let's say, 5 years, and then they would turn around and lend that money to somebody on a residential mortgage who's looking to purchase a house. In terms of the bond market, people might hear that term, not know exactly what that means. Really, I think of it as two sides of an equation. On one side, you've got companies that are looking to borrow money. So those could be telecom companies, energy and pipeline companies, banks themselves. On the other side of the equation, you've got parties that are looking to lend money. So for example, asset managers that are looking to lend money to earn a return for their clients. Pension funds, same type of thing. Insurance companies, they need to lend money to the bond market to invest the premiums that they're collecting from insurance policyholders. So you can think of a bond market as really the clearinghouse where those two sides of the equation meet. So really, interest rates in the bond market are really the interest rate that's agreed upon by both sides of the equation, where people are willing to borrow money and where people are willing to lend money. And they agree on a particular interest rate for a particular period of time. And so really that's what the bond market is. And so really when you're getting a mortgage rate from the bank, that mortgage rate is largely driven off of what the government yield is. So if 5-year government bond yields are 1% in the market, likely your mortgage rate is going to be about 2.3%, give or take. Conversely, if 5-year government bond yields are way higher, if they're 5%, then you're looking at a mortgage rate of probably around 6.3%, give or take. So your mortgage rate is largely driven by the underlying yields in the bond market.